Hello and welcome. Today we are going to dive into the world of mutual funds in India and, just demystify the whole thing. We're kicking things off with the most popular category out there, equity funds, so you can really get a handle on how they work.
Let's be real for a second. Have you ever looked at a stock market chart and just felt lost? With all the blinking numbers, the crazy jargon, and everyone giving you different advice, it's super easy to feel overwhelmed. It can feel like you're trying to learn a whole new language.
So here's the big question. Could mutual funds be the simple answer we're all looking for? Well, for a lot of people, they absolutely are. They give you a way to get into the market that's flexible, and you don't have to be a finance genius. They're basically designed to be a hassle-free option for pretty much anyone. But get this, it's kind of wild. A report from Boston Analytics found that less than 10% of households in India actually invest in mutual funds. That's a tiny number, and it tells us there's a huge knowledge gap out there. And that's exactly what we're going to fix today.
Okay, so what is a mutual fund, really? At its heart, just think of it like a big potluck dinner for your money. You, me, a bunch of other people, we all chip in. Then a professional manager takes all that money and invests it for us in things like stocks and bonds. It's teamwork for your wallet.
All right, here's our game plan. We'll start with a quick intro. Then we'll break down the two main ways funds are sorted, by time horizon and by what they actually invest in. And then we'll take a deep dive into the most popular type, equity funds.
So, let's talk about where mutual funds fit in today. I mean, they've really gone from being this kind of niche thing to a major player in personal finance in India. For so many people, they're not just an option anymore. They're the go-to tool for hitting those big life goals, like saving for retirement or your kids' education.
Now, how do you tell all these funds apart? Well, the first big difference all comes down to one simple question. How easily can you get your money back? This is all about the fund's time horizon, and honestly, it's the first thing you really need to understand.
First up, you've got your open-ended schemes. The best way to think about these is like a door that's always open. You can put money in or take it out on pretty much any business day. There's no fixed end date, which gives you a ton of flexibility. And on the flip side, you have closed-ended schemes. For these, that door is only open for a little while, right at the beginning. It's called the New Fund Offer, or NFO. After that short window, that door closes and your money is typically locked in for a fixed amount of time. So the bottom line here is all about liquidity, how easily you can get to your cash. Open-ended funds, high liquidity. You can get your money whenever you want. Closed-ended funds, low liquidity, because your money's locked in. It's that simple. Anytime access versus a fixed-term commitment.
And, there's always something in the middle, right? These are called interval schemes. They're kind of a hybrid. Most of the time, they're like a closed-ended fund, but every now and then they open a small window to let people buy or sell.
Okay, so we've talked about the when, how long your money is invested. Now let's get to the fun part, the what. What is the fund manager actually buying with our money? This is the second major way funds are classified, and it's all regulated by SEBI, the Securities and Exchange Board of India.
And that brings us to the most important rule for today. If a fund calls itself an equity scheme, SEBI has a rule that says it must invest at least 65% of its money in stocks. So simply put, its main playground is the stock market.
All right, let's zoom in and really unpack the different flavors of equity funds. Getting a grip on these categories is going to help you figure out which type of fund might actually match up with what you're trying to achieve with your money.
But first, to really understand these funds, we got to know how the market itself is organized. SEBI has these really clear definitions based on company size, what we call market capitalization. The top 100 biggest companies, large cap, the next 150, mid cap, and every single company after that is small cap. This is the foundation for everything else. And here's how that all translates into actual fund rules. So, a large cap fund has to put at least 80% of its money into those top 100 big, stable companies. On the other hand, mid and small cap funds are all about chasing higher growth, which of course also means a bit more risk. And then you get hybrids, like a large and mid cap fund, which tries to give you a nice balance of both. Now, it's not just about company size. Funds also have their own investment philosophies. You've got value funds. They're like bargain hunters, always looking for good stocks that they think are on sale. Then you have contra funds, which go against the grain and bet against whatever is popular at the moment. And here's a fun fact. A fund company can only offer a value fund or a contra fund, never both.
And the list goes on. You've got multi-cap funds, which spread your money across large, mid, and small companies all in one package.
Then there are dividend yield funds for folks who want a potential income stream from companies that share their profits, and focused funds, which make big, concentrated bets on just a handful of stocks, no more than 30.
One super popular category you'll hear about is ELSS. These are equity funds that also come with a special superpower: tax benefits. Now, the trade-off is that your money is locked in for 3 years, but it's a great way to invest for growth and save on taxes at the same time. Kind of a win-win.
Phew, okay, so let's do a quick recap. The main takeaways are this. First, mutual funds are sorted by their lock-in period, open, closed, or interval. Second, they're sorted by what they invest in, like stocks or bonds. And third, within equity funds, they're broken down even further by company size and the fund's specific strategy. So, we've covered a ton of ground on equity funds today, from large cap to ELSS. But honestly, we've really only just scratched the surface. This is just one piece of a much, much bigger puzzle.
Because the world of mutual funds goes way beyond just stocks. There are whole other universes out there, like debt funds, which are all about stability, and hybrid funds, which try to give you the best of both worlds by mixing everything together.
And that is exactly where we're going next time. We're going to break down all of those other categories in the second part of this series so you can get the full picture of every option you've got as an investor.
So, now that you've got a solid grip on equity funds, are you ready to check out the other side of the investment coin? I hope so. Join us for part 2, where we'll dive deep into the world of debt and hybrid funds. See you then.